As I've said before on this channel, the Fed has gotten themselves into a real pickle. When we're talking about politics and economics, which are inextricably linked, oftentimes you have to think like they think, which is what is the lesser of two evils? What is the most politically palatable thing to do during my administration to keep kicking the can down the road? And there's a growing number of economists that are pushing the idea of the Fed changing their 2% inflation target. Now, why would they say this? Because if the Fed sticks with its 2% inflation target, um, what is going to be the end result of that? They have to keep raising interest rates, and we haven't even seen the effect of the interest rates in 2022 because it takes a while for them to work their way through the economy, meaning everyone's refinancing their loans, credit cards are going at higher interest rates, yada, yada, yada. So it takes a while to really work its way through the borrowing cycle. But the Fed will have to keep raising interest rates, which will crush the economy, crush the job market. And so a lot of economists are saying, hey, what's the lesser of two evils? It is raising that interest rate, which will also have consequences. Again, when you're forced to make these decisions, uh, you're operating in a clown world, in a Ponzi scheme. When you have to choose between, hey, inflation because of rampant printing and mismanagement, or very high unemployment rate. The system that you created, the system that you work within, Fed, is broken. But we have to live within it too, and we need to make the best decisions. So let's take a look at this article here from Zero Hedge and think through this problem. Okay, so El-Erian, I've talked about him before. He's a well-known economist. He says the Fed needs to raise its 2% target. And Zero Hedge here saying, back in 2022, they said at some point the Fed will need to concede it has no control over supply. What do they mean by that? The supply chain is a large part of what's causing inflation. So a lot of people think it's money supply. That definitely adds to it. But the supply chain breaking down, meaning less supply, higher demand, is part of the problem too. So if they lower demand and it's at equilibrium, they're still going to have inflation if supply doesn't go above demand, if that makes sense. Zero Hedge here says that's when we start to get leaks in the raising inflation rate target, meaning they're going to start to jawbone, hey, maybe it's 2%. I mean, what do we even base that off of, anyways? Let's go with 3 or 4. And then it follows here. They said, in just a few months later, that is precisely what happened because, according to a growing number of economists, such as Obama's top economic advisor from 2013 to 2017 and current economic professor at Harvard, John Furman, to bring price increases down to 2%, we may need to tolerate unemployment of 6.5% for 2 years. So, if you're Jerome Powell, how would you think through this problem? You would say, okay, I'm going to stick with it. Everyone's going to hate me. And, at the end of my term, I'll get kicked out and they'll reverse all my policies. So what is the lesser of two evils? And to assume that Jerome Powell isn't affected by politics at all, I think is wrong. Further reading here, who added that to avoid a social crisis, stabilizing at 3% inflation rate is probably healthier for the economy than stabilizing at 2. So while fighting inflation should be a central bank's only focus today, at some point the Fed should reassess the meaning of the victory in that struggle. So what would happen in society if 6.5% unemployment? How do you think social unrest, how do you think politicians are thinking about that, number one? And number two, what is happening to government spending? Because that's ultimately the cause, because they take up a larger percentage of GDP, no matter how much we make, when people need to rely on social programs to survive. Further reading. The point Furman, a lifelong Democrat, was making was simple. If the Fed's inflation target does not rise from 2%, it would lead to at least 6.5% unemployment rate in 2024, which would translate to no less than 10.8 unemployed workers, an 80% increase from the 6 million today. Needless to say, this would be political suicide for the Democratic administration. So all these cross currents in political infighting is going on. Excuse me. So they're between the reason we've gotten here, and I hope any longtime listener of this channel knows this. We're screwed. So the fact that they have to make these decisions is because we're screwed. So they're just trying to keep the thing afloat and keep the people with pitchforks from knocking on their door at this point, because we've gotten ourselves in so much debt. Our options have become limited. All right, further reading. To be sure, there's a huge implication to raising the inflation target. What would you guess those would be? Okay. The least of which, well, is higher inflation, as well as sharply higher asset prices and catastrophic loss of credibility in the Fed, which is already a very thin line. Remember, I'm not even thinking about raising rates. There's still a veneer of credibility because they have a lot of power that commercial banks don't have. The least of which isn't quantitative easing, quantitative tightening. Further reading. And yet, when the trade-off is social unrest, which is inevitable if the Fed plans to keep rates at 5% or higher for several years, then the alternative is palatable. So we have social unrest because of unemployment and higher interest rates, an economy being in a recession or depression, or raising the interest rate target. Which one's harder? Obviously, going through that social unrest. The question is, does Powell have the stones to do it? Because what that would do would allow us to kick the can down the road for longer, in my opinion. Why? Because money, it washes out all the bad investments that our economy is kind of relying on, in these zombie companies that don't make any money, but they have free, easy, cheap money that keeps them afloat. It kind of washes all that out, but that means a lot of pain. It just allow us to stick around the dollar for a little bit longer if we took that route. Further reading. So palatable, in fact, that the report in November, Goldman and T.S. Lombard also got on board with a former writing that, given the most that most would agree that the fast reduction in inflation to 2% is unlikely, we can now have a debate whether raising the G10 inflation target to 3 to 4% range is more optimal for reasons of maintaining employment levels or public debt sustainability, that the 2% goal, which would not be possible if inflation was sticky at 6 to 10% range, which we are in the sticky range. Inflation is very hard to just turn off, as you've probably seen. And it comes with consequences. Raising interest rates means that the economy slows, because our economy is based off easy, cheap money and speculation. Reading down here at the bottom. This is one reason why I have long believed, as many others, that the Fed's ultimate bails and raises the inflation target to 3%. Powell does not have the same license to keep unemployment high and real growth low for an extended period of time like Volcker did. My guess, Powell knows that, meaning Powell knows that he has more limiting factors than Volcker, and that that limiting factor is our debt, right? That's that rock in the hard place, because we've come to this point in the Ponzi scheme where it's like, okay, well, so if we raise interest rates, there's a lot of bad things that are going to happen, not least of which is government expenditures go up. So what are we going to do? You see the problem? And you, if you're listening to this channel, you're one of probably 5% or less of Americans that even know that this is the reality, including politicians. There's politicians out there that go, why don't we just give everyone $1,000? Why don't we spend money here, hand money over there? And they don't realize the gravity of the problem that we're in, and that is there is no getting out of this death spiral. We're in it, and it's just a matter of how long it extends. So if you're a wise person, you see what's coming down the road, which is the dollar's not going to exist in the future. You will invest accordingly. All right, back to this article here. So Mohammed El-Erian, told Bloomberg TV the Fed won't be able to get the inflation down to its 2% target. El-Erian is a very smart dude. And he said they won't be able to do that without crushing the economy, even though he too conceded that the central bank is unlikely to officially change the goalpost. Instead, Fed will have simply pretend That's 2% target has been has even as it resets higher. So it's going to be, to maintain credibility, we've reached 2% by changing how inflation is measured, something like that. Okay. And you guys have all experienced that in the last year. Inflation in your life is probably 20%. And meanwhile, the highest reading you got of CPI was like 9. So it all depends on what you spend money on. He said, you need a stable inflation rate, call it 3 to 4%. El-Erian, the chairman of Gramercy Funds, told Bloomberg Television. I don't think they can get CPI to 2% without crushing the economy, but that's because 2% is not the right target. They need to be at 3%. And El-Erian talked to Bloomberg. Let's take a listen to what he had to say.
Can get CPI back down towards 2% without getting unemployment through 5.
I don't think they can get CPI to 2% without crushing the economy. But that's because 2% is not the right target for our economy. When you have so much stuff going on the supply side, an energy transition, a change in the supply chains, geopolitical issues that come onto the supply side, the way the labor market functions. It's a long list of supply issues. You need a higher stable inflation rate, call it 3 to 4%, to allow for the lubrication that's necessary for these changes on the supply side. But you know what, John, you heard me say this when I was with you.
Liquidity, money to flow. If money is very expensive to borrow, the lubrication isn't happening. So more supply isn't coming online.
Last time, you can't change an inflation target when you've missed it in such a big way.
Well, you can't change the target, but maybe you can tolerate an above target inflation rate and just tolerate it, Mohammed. Now, you've mentioned that a couple of times now, and I'm picking up on it.
I think that's where we're going to end up.
You think that's where we go?
That is where I hope to go, and I hope that that's a stable world, John.
Do you think they're going in that direction now, ultimately?
I don't know. For that, you'd have to ask our colleagues on the FOMC. I don't know where they are. I don't think they know where they are. They are too data dependent. It is right to take data into account, but you've got to have a view of where you're going. It's like driving on a freeway. Yes, take into account how fast the other cars are driving, but you need to know where you're going. You need to have a view of how you're going to get to that destination. And that's why it's really important to have a secular and structural anchoring to your data dependency.
So one of the things I've kept in mind is the ultimate, like who's driving the car right now. A lot of people think it's Jerome Powell. I do think it's Jerome Powell when it comes to raising rates. But the real question is, what happens when the political pressure, like social unrest, political pressure of raising interest rates really takes its effect on these politicians, where they're having to deal with unemployment in their district? How are they going to react to that? I don't think they're going to react how they always react, which is, what is the instant fix? What's the easy button? And I've said this before, the easy button's gone. That's where we're at as an economy. In 2008, we hit the easy button, and since then we've been just hitting the easy button. Print more money, print more money, print more money. And the problem today is that we have so much debt that servicing the debt, when we print more money, costs even more of the government expenditure. So that's that debt spiral that I've been talking about, which is you take on more debt, then your interest rate goes higher, which means you have to take on more debt, and it just keeps going. That's where we're at today. Rock in a hard place. I do agree that this is probably the lesser of two evils, but what do you think is going to happen to stocks, crypto, real estate, all those things if the Fed comes out and says, hey, okay, we concede. Inflation is now going to be 3 or 4%. They're all going to shoot way higher, in my humble opinion. Let me know what you think in the comments below. I'll see you all in the next one. Peace.